So, it works. A heartfelt welcome to this session 3, and good morning and good afternoon to all of you listening in and being here in a virtual format. My name is Thomas Jorgensen. I'm a Deputy Director General here at ECB Banking Supervision. I basically deal with supervising the largest global systemic banks and all of the international banks which have now set up a foothold here in the European Union. Before going into the substance of what we will cover here in session 3, let me touch upon a few housekeeping issues. For each paper, the presenter is given 20 minutes. The discussion will be given 10 minutes, and that leaves us 10 minutes for the Q&A. We will have questions here from the room, but also from a virtual format after. We are on a quite tight schedule, and I will be relatively strict here and ask both the presenters and also the discussion to keep to this time schedule that allows us the time for the Q&As here also. And Andreas and Stefan will show the time to guide you a bit here. So before we get cracking, let me say a few words about each of the papers, and let me start here with the first paper in the first session. So the first paper deals with how climate shocks affects the banking system by looking at the El Niño phenomenon. And the paper finds that the El Niño impairs the value of the amenities in a number of affected US counties. That reduces quite significantly the mortgage lending and a bit less so the house prices. These local effects, they aggregate at bank level, and they also have effects on mortgage lending in non-affected counties. The study also gets into a quite interesting debate whether these effects are caused more by demand or bank supply effects, and there seems to be some evidence that operating leverage that matters as to bank behavior and also resilience to climate shocks. So in other words, banks with a stronger exposure to branches and other physical assets, well, they appear to be suffering more from the realization of adverse climate shocks. This paper is presented by Assistant Professor Filippo with me here today, Nicola Limodio, both from Bocconi University. Nicola is joining online. And after that, we will have a discussion of this paper here by Alexander Popov. He is an advisor here at the ECB at Director General Research. So with this, let me hand over to you, Filippo, for the first paper. Thanks.
Okay. So thank you very much for the invitation. So this is joint work with Nicola Limodio, who's with me at Bocconi, and he should also be online. So I guess, I don't have to spend much time motivating why studying climate shocks and banking is important in this building. But let me just say one thing. So here we're looking at physical risk for financial institutions. And, we know that policymakers have been looking into this and how well banks are prepared to manage this climate risk. One thing that I would like to say is that most of the evidence that we have on physical risk is related to extreme weather events. So we think that climate change in the future will make extreme weather events more likely and more severe. And this is why people have been focusing on that. However, natural disasters and these extreme weather events come also with a lot of other problems because there is typically a lot of government intervention after natural disasters. There is insurance policies that kick in. And so, studying the impact of these very extreme weather events is informative on some aspect, but could also be difficult from the empirical point of view. So what we do in this paper is that we propose and test a new mechanism. So we look at one specific climate shock that I'll be describing later. And we think that this impacts natural amenities, which means kind of all the environmental qualities in an area. This will then impact house prices because if the natural environment deteriorates, also the desirability of living in a location will go down and house prices will be impacted. And then this will impact mortgages, and overall bank's balance sheet. We do this by exploiting this recurring natural phenomenon, which is called El Niño. We're going to be studying effects on the US, but El Niño is a big global phenomenon that affects weather throughout the world. And interestingly for us, and I'll be spending more time on this, El Niño is unpredictable in the time series and has a heterogeneous impact across the US. So we're going to be looking at both sources of variation, time series, and cross-section variation. So, and by this, I want to admit that and acknowledge that this is a paper about short-term fluctuations, not about the long-term consequences. So this is more a paper about climate shocks rather than climate change. Right? So the short-run fluctuations in weather. So I want to spend some time describing the mechanism. So this is an empirical paper, but we have, this is kind of what our key contribution is to provide some evidence for this mechanism. So let me just explain it. And given that I'm an empirical person or theorist, I'm just going to do a lot of graphical evidence. So let's take a bank balance sheet. So this is quite a complex bank. It's a bank in the US. So they have loans, mortgages, bonds, and also a lot of other liabilities. In particular, we're going to be focusing on mortgages, which is actually the largest asset class on banks' balance sheet. So these mortgages are given out to borrowers to buy houses. Now, what you see is that the value of real estate depends not only on the house itself, but also on the natural environment around it, captured there by that tree and that little squirrel. Now, suppose that there is, this of course provides collateral value for the mortgages, right? So this is providing it is supplying collateral for these mortgage loans. Now, suppose that there is some shock, which for now, just called El Niño. And what this shock does is deteriorates the value of natural amenities. So now the trees become worse off. Now, this will also impact then the value of the house itself, okay? So the value of collateral will go down, and by impacting the value of collateral will also impact banks' ability to supply mortgages, okay? Because kind of the market value of collateral goes down, so it's going to be harder for these banks to securitize mortgages attached to these houses, and in general, it's going to be impacting the ability of banks to supply mortgages. Right? So this is our simple mechanism, and then essentially what we are going to provide evidence on is how this El Niño affects natural amenities, house prices, and then lending. And this will affect not only the flow, so the new mortgages that the banks will do, but also you think about affecting the stock of existing mortgages. So all of the loans made in one specific area are going to be affected by that. That's why it can have an impact on banks' balance sheet, also because mortgages are, again, the largest asset class on banks' balance sheet, so they have the potential to affect also other parts of it. Okay, so this is how it transmits. So we'll study how the climate shocks affect banking through, and we're going to do this in different steps, just in case I don't get to finish. So first, we're going to be looking at county climate. So this is about the US, first of all. Okay, so we're going to be looking at counties, climate. We're then going to be looking at house prices and mortgages in the same county, okay, so provide descriptive evidence. We're then going to link it to this concept of the natural amenities deteriorating, okay? Now, for natural amenities, this is actually something difficult to measure. A lot of the measures here about natural amenities are not time varying, and we came up with some measures that are time varying. We're then going to aggregate this at the bank level and see what happens for overall bank's balance sheet. And then, as also was told by the chair before, we're going to try to tease out a bit demand and supply. So let me tell you what we find. So first of all, the first aspect, we're just going to validate what we already know about El Niño, but this was important for us to see. And especially what we're going to find is that the El Niño shock is not related to natural disasters. And then we're going to be looking at house prices and mortgages, and we're going to find these heterogeneous effects depending on how the counties are impacted. We're going to be looking also at natural amenities and see that they worsen when temperatures go up. This is what the El Niño shock does in particular, will increase temperatures. When we aggregate the effects at bank level, we see that overall bank lending is also impacted. And demand and supply suggests that bank level factors are key. And in particular, we're going to see also that in kind of our key evidence here is that even lending in unaffected counties, so counties that are not directly affected by El Niño, still see a decline in lending when the bank is exposed to El Niño through its exposure in lending in the affected counties. Okay, so it seems that somehow banks transmit this shock in unaffected counties. We also have this part about we're going to try to find the bank characteristics that make banks climate resilient through a lasso analysis, but I'm not going to have time to do that today, but it's in the paper in case you're interested. I'm just going to hint at it at the end. So identification, this is of course something important. We're going to be looking at this El Niño. So we study effects of El Niño on the US. Why is this ideal? For a few things. So first of all, this is exogenously determined with respect to US climate. It's something that is determined in the Pacific Ocean, and it arises when temperatures in the Pacific Ocean go up above average, plus some other factor. It is very unpredictable in the time series, so climatologists have a hard time predicting this. For example, right now we are coming out of, there is a phenomenon that is called La Niña, which is the opposite of El Niño. We're coming out of that. And there is the possibility now of being in an El Niño period coming in, but there is a 50-50 chance that in the next few months it will develop. But 50-50 is still a lot of uncertainty around it. It is also for us, again, the important part is that this is heterogeneous in the cross section. So there are some counties in the US that are going to experience warmer than average temperatures, other colder temperatures, and then a band of counties in the middle that experiences no change, and that's going to be our control group. So let me just tell you a little bit more about this. So it's actually, El Niño is actually fully spelled out. It's called El Niño Southern Oscillation. So it is a combined system of both ocean temperatures. So this is surface temperatures of the Pacific Ocean. This is easy to measure. We can see when temperatures go up. But it also needs something else. It also needs winds pattern. So these are surface winds that go around the Pacific Ocean. So typically, what happens is that winds go westward, okay? But if there is an increase in temperatures and these winds that typically go westward now start weakening or even go the other way, then you have these warm waters that is typically kept around Asia, Indonesia, spills over towards the Americas. And then given that the Pacific Ocean is this very large mass of water, the largest ocean in the world, then this will also affect climate in the American continent, okay? So of course in Latin America and in the Caribbean too, but also the US. The most significant impact of El Niño in the US is due to the fact that it also shifts this jet stream, which has instead these very high altitude winds that in the US are important because they separate warm from cool air masses, okay? So just to show you this in a picture, essentially what we have is that when there is an El Niño event, the jet stream is impacted, it changes pattern. And so we're going to have that the north of the American continent experiences warmer temperatures, colder in the south. And then there is also something on precipitation that we will partly explore in the robustness. So how do we measure El Niño? We look at this temperature index. So that's kind of one of the necessary conditions, not sufficient, but necessary. We're going to be focusing on, given that, this of course, there are a continuous here of surface temperatures. We want to identify kind of the strongest event in El Niño. So we choose to take this cutoff of 1 degree Celsius. So when temperatures in the Pacific Ocean are above 1 degree, we're going to be defining this as a top 5 El Niño year. Okay, and you see the years below on the x-axis. Okay? So we have these 5 top Niño events. And this is our cross-sectional variation, which is this map that we get from NOAA. So again, you see the north experiences warmer than average temperatures. This we call it positively exposed. The south is colder temperatures, and then this band in the middle is not affected. This is in terms of temperatures. So we put together a lot of data here. Don't have time to go through this, but we have quite a long time series, at least for what I'm used to do. This is like 40 years of data. And we look at this temperature station data from NOAA. Mortgage lending comes from HMDA, and house prices from these other agencies. And I'll be talking about natural amenities later on. So let me first tell you, so what do we, the empirical analysis here is very simple, given that this is a very nice shock, that it's, again, we exploit these 2 dimensions of the shock, the time series variation and the cross-sectional. So the empirical analysis is quite simple. First, we're going to be looking at climate to validate what we already know by NOAA. Okay? And we're going to be looking at this. So you're going to be regressing temperatures averages for a county in a year and the probability of a natural disaster, okay, which we get from FEMA, which is this agency that is called to intervene when there is a natural disaster. We're going to be regressing this this is our key variable. So it is exposure, okay, of the county. And I here means that it can be both positive or negative, so either in the north or the south. And we're going to be multiplying this for an El Niño year dummy, which is equal to 1 in one of those years where there is a top 5 El Niño event, which I showed earlier. And then we're simply going to have a county and year fixed effects to take into account, of course, difference in counties. So we're going to be effectively looking at changes in temperatures and changes in the probability of natural disasters. And we the cluster standard errors at the county level here. All right, so very simple. This is the shock. So in positively exposed counties, first we're going to be looking only at those against everybody else. We find that on average, in an El Nino year, temperatures go up by 0.6 degrees. Okay, so the effect is not large, and this we know we expect that is El Nino doesn't have that strong of an effect in the U.S. Has stronger effect in the Caribbean. Negative exposure, similar, minus 0.5. When we put them both together, it seems that most of the effect, it gets a larger increase in temperatures compared to the control group counties in the positively exposed counties. Right? Importantly, we see if we look at the probability of natural disaster, we actually see that if anything, in this positively exposed counties, the probability of natural disaster decreases. Right? So when temperatures here go up in the north, the same is not accompanied by increased probability of disaster, but if anything is lower. That's why we think that this is different from just studying natural disasters. It does go up in the south, and this is because we know that El Nino increases the chances of hurricanes in the Caribbean, and so there is Florida and Texas there, so they are more likely to see a disaster. Now, if we do the same regression, so very same regression, just changing the dependent variable to be total mortgage lending in the county, we're going to see that actually mortgage lending declines significantly in the positive exposed counties by 11%, and there is no effect really in the south compared to the control group. And this is why this is consistent with the fact that we know that there's a lot of intervention when there are natural disasters. Also, credit demand goes up in these counties because you need to reconstruct a lot of the physical stuff that is destroyed, but in the north there is this decline. So as of now it says increase in temperatures in the north, not lower probability of disasters, but lower lending, and this is also accompanied by a decrease in house prices. So this is house price index that we got over the same period from 1980s onward. There's also decline. So why? So one may think, well, maybe it's a good thing actually that temperatures go up in the north. Right, so it's actually, this could be a positive effect. Why do we see actually a decline in lending and house prices? This is where the part of natural amenities kicks in. So natural amenities, the idea is that El Nino lowers house prices by deteriorating these local natural amenities, the desirable characteristics of the location. So the first test that we want to do is whether, in the cross section, you can divide the United States into high and low amenities areas. We want to see if El Nino effects are stronger in high amenities areas. And we get this measure from this US Department of Agriculture that combines many different measures. Okay, this is only a cross section, one not time varying. The map aligns with your intuition, right? So the high amenities area here west in California, Florida, and there is something here in the middle, in the Midwest, that is less appealing. And if you do then the same regression, but interacting also with these natural amenities, what we find is that house prices especially decline in this high natural amenities area. This is a dummy equal to 1 if you are above the median. And especially there is a triple interaction here. So in the positive exposed counties, in high amenities, there is a further negative decline. Okay, so it seems the effects are stronger here. Same thing is true for lending. Right? But does El Nino itself impact natural amenities? Now, for this, you need to have some measure of natural amenity is time varying. What we ended up using, but we're working more on this, is the salinity of the local soil and water. So salinity is important because it's a key input in natural amenities. When the level of salt is high in the soil, this reduces the chances that the vegetations grow, reduces the nutrients that to plants and animals in general. And when you have rising temperatures, there's more evaporation, which increases the presence of salt, and this could lead to more aridification and drought. We're also finding now in new results, in fact, that El Nino increases the chances of drought in these areas. Okay? This is nice because it allows us to have this to be a time varying measure of natural amenities. Okay, we use this, take this from other papers, and we find again that in the counties that experience an increase in temperatures, both this measure of water and soil salinity go up, right? Which is consistent with this idea that natural amenities deteriorate in these areas. Right? Now, in the remaining time, just now that I've showed you all this, essentially, okay, this is all county level. What about banks? So if we just aggregate this up at the bank level by looking at whether banks are exposed to these counties or not, depending on their mortgage lending, okay, this is how we measure it. So we see the share of mortgage lending by that bank in that county. And we're going to be splitting up again between positive and negative. Okay. Here, for simplicity, I'm just going to be focusing on the total exposure. And we see that also total loans go down, but also other parts of the balance sheet are affected. So total assets go down and also deposits. Okay? So this seems to be transmitted to the overall bank balance sheet. And in particular, this is true for real estate loans, but also commercial and industrial loans. Right? So it's not just, this is what we expected. This is the HAMDA lending part from before, aggregated at bank level, but this is new for firms. Yeah. Now, how can we tease out supply and demand? This is a usual problem in this part. So the effects at the county level could be summing up both. The effects at bank level, same story. So we can look at the bank county year data set from HAMDA. Okay? And essentially what we'll be doing is that we'll be throwing in these regressions. So this is mortgage lending by the bank in the county, throwing both the county exposure and the bank exposure, and absorb each one at a time with either county year fixed effect or bank year fixed effect. And we're going to see which one wins, in a sense, right? Kind of do a horse race. Okay? If we do that, we're going to find, we put them both in. So you have, again, positive bank exposure and positive county exposure matter. If you absorb the county with county year fixed effect, the bank exposure still matters. But when you do the opposite, so you absorb these with bank year fixed effect, these ones don't matter anymore. Seems to suggest here that the bank factors are more important than the county factors. And if you want, just more directly, if you just show that in the lending part, you're looking at banks that are positively exposed, and we look at their lending in the affected counties, and in the unaffected counties, we see kind of the same coefficient, which means that the positively exposed bank transmit this shock even into unaffected counties. Okay? So even in that control group of counties, they reduce their mortgage lending. And this has nothing to do with the El Niño itself, other than through banks' exposures. Okay? We do a lot of additional things here. Again, I mentioned this La Niña, which is the opposite. The interesting thing about La Niña, I'm just going to say this, is that it provides the opposite geographical pattern, and we see the opposite effect. So it's not just a north versus south, in case you're worried that that's what we are picking up. El Niño reverses that, and we find consistent results and a lot of other things. So just to conclude, given that amount of time, so we studied financial transmission of this climate shock. We think we provide a new mechanism that doesn't go through natural disasters, but rather through these natural amenities that can impact house prices and then lending. And I haven't showed this, but there is this part where we look at whether, which banks are less impacted by this El Niño shock. And we find that those with lower operating fixed costs, so we call this operating leverage, are more climate resilient. Okay? So future research, maybe we'll be looking at other countries, not the US, which could also be impacted.
Thanks a lot, Filippo. That was exactly 20 minutes, so well done. So now we will hear Alexander as the discussant. Thanks.
Okay, excellent. Thank you very much for the invitation. It was a pleasure the very interesting, important paper, really pleasure to read. I learned a lot. And I guess the motivation is clear at this point. Anthropogenic climate change is making the planet hotter and drier. Now, this has been known basically since the 19th century, when the Swedish scientist Svante Arrhenius calculated mathematically the link between the concentration of carbon dioxide in the atmosphere and the temperatures of the planet. So I guess the point of the paper is, broadly speaking, why haven't we done enough? And some of the reasons are obvious. One is that people didn't believe the science for some time. But the most sinister is that even if we believe the science, we think that this is a problem that our grandchildren will face, not us. Now, last year, we were faced, at least in Europe, with a reminder that it's not just our grandchildren that will face this problem, but we as well, when the rivers in Germany went dry and uncovered these stones that had been put there in the 17th century when the last dry spell was. So we need to urgently understand all the ways in which climate change affects the economy, both the financial sector and the real sector, and of course to act urgently, this is clear. But let's start with the understanding, and that's where the paper is going. It is studying the effect of one particular climate change phenomenon, which is the intensification of El Niño and its effect on house prices and bank lending. And it finds that as a result of El Niño, climate conditions change, meaning temperature levels and volatility, but also the salinity of the soil. House prices decline, and banks react. Deposits and mostly mortgage lending go down. And most importantly, there seems to be a transmission from counties where the banks are affected to counties which are not affected by El Niño. So there is this cross sort of geographic transmission via bank balance sheets, which is very important to know. So it's a well-executed paper on an important topic. I have very little to contribute, but I had a few remarks that I hope will sort of tighten up the analysis and make the picture more complex and interesting. So my first comment is on the empirical model. This is the workhorse regression, well, the two workhorse regressions that the authors run, which is essentially an outcome variable regressed on bank exposure interacted with El Niño or county exposure interacted with El Niño. And that allows them to control for county fixed effects or bank fixed effects and time fixed effects. What I worry about is that in this workhorse model, a lot of unobservable county heterogeneity in the first regression and bank heterogeneity in the second, which varies over time, is swept under the carpet. So there could be any sort of other forces that are affecting the outcome variable, which vary over time at the bank or county level, and one cannot control for this here the way the regression is set. So as an alternative, maybe already here, which is what you get later in the paper, but maybe already here you can set up this regression in a way that would allow you to show that banks are affected in one county and then reduce lending in another county, which kind of here you don't see. Here it's the second regression is aggregated at the bank level. For that, of course, you would need to look at banks that operate in multiple counties. I'm not sure how many of those there are, but I guess thanks to deregulation, there should be some of those. My second comment is about the treatment versus control. So this is the map of the United States, which Filippo already said, and how the regions are differentially affected by El Niño. And of course, obviously, these regions are also economically different, right? You have a lot of, so the economically most active regions, as far as I can say, New England and the East Coast and the West Coast, California, are not affected. And then you have a very specific region in the South, which is affected, and a very specific region in the North that is affected, and they're very different. So there could be anything that is different in the background, either fixed or moving over time, that may be messing up with your identification. So one way I thought to get to it is this technique which people have used in the literature long ago, is to kind of look at the border regions and really compare counties that are in the northern part of the blue region versus counties in the southern part of the white region, and analogously, southern part of the red region versus counties in the northern part of the white region. So really close to the border of where El Niño acts, and compare those counties because they are sort of the same economic zone in some way, so they should be subject to similar unobservable trends. Okay, my third comment is about the main explanatory variable. So you look at top 5 El Niño years, and you look at how these affect climate conditions, house prices, bank lending, what have you. And this effect is silent about the underlying mechanism. And I know that you have a whole section about the underlying mechanism, but at one point you kind of assume it is salinity that is responsible for the bank lending effects that you observe, but you can actually test it explicitly. So the alternative approach would be to regress the changes in the dependent variable, be it bank lending or house prices, whatever it is, on a set of environmental variables that change over time. So salinity, temperature levels, temperature volatility, you have this data. And then use the El Niño years as kind of an instrument for that, because this is what is exogenous. Maybe salinity oscillates over time for whatever county-specific reasons, but El Niño would give you an exogenous variation, so you use it as an instrument. And then you could even construct a placebo, kind of extreme weather events that do not change a particular variable. And I'm sure those exist. They didn't have great ideas, but I think, for example, that maybe heat waves, there are heat waves that don't affect salinity, so that could be one placebo. or there may be floods that do not move temperatures, but they affect the local conditions in another way. So anyway, just a few ideas for placebo, but I think you could actually use the environmental variables as explanatory variables and El Niño as an instrument. I think this could be interesting. Then reallocation of lending versus the aggregate effect. Now, you show that the bank balance sheets suffer from high exposures during El Niño events, which is good to document. Is the effect symmetric? So for example, think of temperatures. Exposure to hot counties. So if the bank is in a hot county that experiences higher than average temperatures, that's kind of bad. If it's exposed to a cold county that experiences higher than average temperatures, that's kind of good. So that reminded me of this paper in Nature by Burke et al., which showed how different countries in the European Union will be affected by climate change. And in fact, plenty of countries in the north of Europe will benefit from climate change because they're too cold. So a few degrees more, paradoxically and cynically, would make places like Sweden, Finland, and Siberia, I guess, better off because now conditions are better for agriculture and so on. That's just one part of climate change, right? There are, of course, floods and sea levels rising and so on. But if you look at temperatures only, there are quite a few places that benefit from warmer temperatures. So in the end, is it possible that this lending is reallocated from counties that suffer to counties that benefit in a way that is netted out in the aggregate? So again, you would have to look at banks that operate in multiple counties to do that, but I think it would be an interesting exercise. Rather than identifying the effect, in counties separately, think of the aggregate effect in that way. And finally, what are the sectoral mechanisms that are responsible for what you observe? I was thinking while reading the paper, I think you could dig deeper into why banking conditions change, thinking of the demand, for example. So why are deposits declining in El Niño years? It's important to document that they do, but why is it happening? Is it that the real estate sector is responsible because housing values decline, now the owners feel poor, they withdraw savings? Is it that the agricultural sector is affected because the salinity increases and the crop yields are affected? Or is it the non-farms because climate conditions are now more volatile, they affect the cash flow of NFCs? And I think if you can identify some of those, it would help you more tightly describe the chain of events that you are after. Okay, conclusion. So as the great American comedian Stephen Wright once said, conclusion is the place where you get tired of thinking. So conclusion, it's an important question, obviously. Do adverse climate events affect financial sector and real activity? Main result is intuitive and very important to know. And we need more papers like this, is my conclusion. So good luck publishing it. And maybe my comments were marginally useful. Thank you.
Yeah, thanks a lot, Alexander. Very good intervention. So now is the time that we open up the floor for questions. We have a physical side to that and a virtual side. So I would suggest that here in the physical format that you state your name and also affiliation. And on WebEx, you can raise your flag and also raise questions in the chat itself. And I think Stefan and Andreas will steer that. So let me open up the floor for any questions.
Martin Oemker, London School of Economics. I found this very interesting. One of the things I'm hoping you can clarify, and you may have said it in the presentation, but to what extent you think of this as a stock or a flow effect? In other words, are you mostly thinking about an existing stock of mortgages that banks have that are reduced in value when El Niño comes, or is it about new mortgage lending in a particular year? The second one, to me, seems in some ways more intuitive because it's a temporary phenomenon. So I wonder how large the reduction in value of existing, say, 30-year mortgages would be. But yeah, if you could just comment on how big you think those two channels are. Thanks.
Let me propose we take all the questions and then either Filippo or Alexander can answer that after. So we have a question down there.
Hi, Daniel Guch, European Central Bank. A very simplistic question coming from a practical supervisor. So what I would understand you are describing here is a kind of climatic cycle equivalent of economic cycle, the El Niña. Do you feel your data go into this area of, let's say, stability that we would need to start thinking about some kind of supervisory measures for banks in terms of procyclicality also in this climatic cycle? Thank you.
So do we have further questions? Yes, please.
Thanks, Jacob from the EBA. So I guess I would have thought that people who live in these areas know that El Niño exists already, right? So I'm kind of puzzled by the fact that there's even any impact, right? I would have thought there was a risk premium. You knew it valued your house. The banks would have taken it into account already. So I thoughts on that.
So let me check whether there are other questions on WebEx. Do we have any questions there? No? I had one question on my side, Filippo. You mentioned in the end of the presentation the link with the operating leverage also. I found that quite interesting, but maybe a bit less developed in the paper itself. Could you expand a bit upon the reasoning and what are the effects you see here and why is it that these banks are less resilient on that one? Thanks. So with this, let me hand over to you, Filippo, and possibly Alexander. Thanks.
Okay, so thank you very much for all the questions. Let me start just from Alex's discussion. Lots of points. I will now go over all of them. They resonate well with some of the comments we have been receiving, kind of controls better for what could also be happening, counties and banks and in these different areas. I like especially the suggestions about the placebo, the heat waves that do not impact salinity. I think we could do something on that. And definitely, there could be more real effects of El Niño, right? Agriculture or other things. We don't know whether we're going to put everything into this one paper, but definitely there is, the analysis is already quite rich, but we can further expand it. So thank you very much, and I'll ask you for the slides. So regarding the question, so let me start from Martin. So most of the evidence that we have is in fact on flows. So that's kind of mortgage lending. This is about new originations, and I also agree with you. That's kind of the most kind of intuitive part. So yeah. So as of now, we are not really we're not really saying how much is coming from the affecting on the stock versus the flows. The evidence we have is mostly on flows, but there could be effects also on that. Let me just get to Jacob question. So why, in a sense, why is this El Niño shock? It's happening, and it's temporary. It's just a 1-year shock. Why does this affect house prices even in general? Right, this is a long-term asset. So we know that there are papers, for example, that have shown the house prices move even within the year. Right, in the summer season when it's nice, prices are higher. In the cold season, these are lower, and it's quite predictable, and when winter and summer comes. So there are these effects that do happen. Could be because in that paper they show it's because of thick markets effect. There's more liquidity, and so more effects on prices. Could be behavioral biases that you have. Just the optics of the house and around. If the environment looks bad, then this will depress house prices, even if that it's coming and it's temporary. So we know that these things may be puzzling, but they are there in the data. Related to the last questions, which is also partly related to the other questions that I got. So this analysis that I haven't spent much time on. So we find in this last analysis, essentially, this is a machinery that allows us to see which characteristics make bank more or less resilient in the sense of which banks are more or less affected by this El Niño shock, right? So the key variable that always shows up is this expenses on local premises like bank branches. Okay, so these are fixed costs the banks incur, and we think this makes sense because if this is about physical risk from the shocks, banks that have kind of a larger part of expenses that have to deal with maintenance essentially of their bank branch network, they're also going to be more affected. And this is new and different with respect to, of course, physical exposure from the firms or households that they lend to. It's directly their balance sheet. But yeah, so this, and potentially this could be something. There is this concept of operating leverage for non-financial firms, and this could play a role essentially also for banks. Thank you very much.
Okay, I propose that we close the session Thanks a lot, Filippo. Thanks a lot, Alexander. Very good presentations and discussions. And I think there are important elements and links also to all of the work that ECB Banking Supervision has been doing on climate, whether that's the thematic review, the stress test, the disclosures. And I think also the pricing, Filippo, how the banks in fact are pricing these loans. We are attacking that through the banks, both on the business model side, but of course also on the risk side here. So thanks a lot for this.